Hi, my name is Tim Coleman with Coleman Collaborations Consulting Group. And today I just want to share some ideas with you on if you're thinking of selling your closet business. It's a small business. Most closet companies are $1 million to $1.5 million a year in business. And so today I'm going to use those numbers as an example of how to value your business. So, how did this come about? I went to the Closet Conference and Expo in June of 2025, and then I went to the Closet Summit by the Closet Institute of America in October of 2025, and there was one thing I noticed. Many people were both young and old, so that's encouraging and exciting, but at the same time, I realized that there's many companies that were started in the 1990s and early 2000s, and those businesses are now 20 to 30 years old. The ones that started those businesses are ready to retire. They're ready to be done, but they don't know how to sell their business. They're not sure. They've spent their entire careers learning how to run their business, learning how to operate their business, and they never thought about what's going to happen when they leave their business. Are they going to be able to give it to their children? Are they going to sell it to their employees or a key employee? And so today, I hope to be able to answer some of those questions. So the first one is, what do I need to do to get my business ready to sell? And when you want to sell your business, you, just like when you're selling a home, want to put it in its best light, which means your financial statements, your customer records, all of the things that are your business. Those are the things that you want to be able to put together and organize in a way that a future purchaser will understand. You, the seller, need to be able to explain that to the buyer. If you're like a lot of us, you've been working in your business, but not on your business. When you go to sell your business, that means you have to work on it and not in it. What does working on your business mean? It means that you want to be able to write down all of the things that you do that make your business yours. How do you answer the phone? How do you conduct an appointment? How is an installation done? How do you load a truck? When do you collect a deposit? How do you collect a deposit? Do you take credit cards? What you want to do is you want to learn how you need to sell your business and what you should be doing to sell your business. What should you expect when you sell your business? How does it work? How is a business valued? I want to be able to share with you is what creates value in a business. And number one, the first thing that creates value is how much does your business produce in profit? The term is called EBITDA, earnings before interest, taxes, depreciation, and amortization. So your EBITDA, which is different than your net profit, your EBITDA is a dollar value. So if we have $1 million business and your EBITDA is $100,000, that gives you your profit that some future purchaser will look at to make a decision of whether they want to buy your business or not. And then the calculation that's used to determine value is what's called a multiplier. So for $1 million business, generally speaking, it's 2 times EBITDA. So if we have a $1 million business with $100,000 of EBITDA times 2, the selling price of your business is about $200,000. Now, could you increase that or decrease that? Yes. You can increase that by having good customer records. That would be things like a CRM, customer relationship manager. That's where every customer that you have had for as long as you've been in business or for the last 5 years, the last 10 years, were your customer records, because those have value. Your customer records could increase the price from a 2 times EBITDA to a 2.1 times EBITDA or 2.2 times EBITDA. The other thing that could increase value is if you have good accounting records, whether it's QuickBooks or some other accounting program where your records are accurate. You keep all of your inventory in the computer. You keep all of your pricing structure in the computer. All of those things add value. Take value away. Many years ago when I had my business early in the 1990s and we would sell a tie rack, Somebody would come up to me and say, how much is a tie rack? And I'd look at it and I'd say, $20. And then the next person would come up to me, and depends on what day it was, I'd say, it's $25. And so having accurate records and a method for determining selling prices, those things can add value or take away value. If you don't have all of your customers in some fashion on the computer, then it take away value. If you don't have your bookkeeping done accurately, take away value. So there are some companies, I'm not saying yours, but there are some companies that, yes, they have QuickBooks, but the only thing they use it for is to create an invoice. And when that invoice is paid, they don't go back to QuickBooks to mark it paid, because all they're doing is using QuickBooks to create the invoice. You want as much of your company in QuickBooks, you want as much of your company in a CRM program. So those were the first two. The third one, processes, are all of the processes that make your business yours written down. And if you are not there, will those processes be followed? If you have to be there for the processes to be followed, your business doesn't have as much value as if it's all written down and everybody knows what they're going to do, then it has value. The next thing are systems like, how do you make purchases? If you're going to order from Hayfla, or you're going to order from Richelieu, how do you do that? Do you go to their online portal? Do you call your sales rep on the phone? Don't tell me that you fax it in anymore. Do you have forms that you use that says, these are the items we need to purchase? Do you know how much you're supposed to pay for those items? Or do you just rely on your supplier to tell you what the cost is? All of your systems need to be written down. What are the assets of your company? Do you have trucks? Do you have loans on the trucks, or do you own them outright? Do you have machines in your shop? Are those machines paid for, or are they leased? Are those machines old? If they're old, they don't have as much value. If they're new, they have more value. What has been the maintenance record of those machines? We all know that if we change the oil in our trucks, rotate the tires, that alone helps us prevent future mistakes and malfunctions on our vehicles. But the same things can happen on a machine, mistakes and malfunctions, if we don't maintain them. Do we have a regular maintenance program for the machines in our shop? Do we regularly use sharpened tool bits, sharpened saw blades? Or do we just wait until the last minute, they're dull, and then we replace them? All of those things that are written down, that have a structure and a schedule to them, adds value to your business. If you don't have structure, you don't have a schedule, it decreases value. The employees that you have in the business, have they been there for a while? Will they stay? The employees that have been around for a while already know what to do. So when you're no longer involved, the company will still be able to carry on without you. That has value. If your employees have not been around that long, then the value isn't as great, because they're not going to know all of the ins and outs of your business. So the value of the employees and how long they're going to stay on after you sell the business with the new owner, that's going to either increase or decrease the value. And then what I would call contract jobs. So let's say that you've got an apartment building complex that has 100 units in it, and they're going to be building that out over the course of 6 or 8 months. Well, the value of that contract increases the value of your business, because the purchaser, the one who's going to buy the business, would be able to count on that as instant income. Or repeat business, home builders, remodeling contractors, interior designers, professional organizers. If you have all of those as your clients, then the value increases, because the one who buys your business will expect that those relationships will continue. Those future sales will continue. Your job as the seller is to make sure that the buyer has the transition between the custom home builder, the remodeling contractor, to be able to do the introduction, make sure that the introductions happen, make sure that the transition is smooth from you selling the business to the new buyer. So value of a business, $1 million business produces 10% profit. is $100,000, 2 times EBITDA. That's value of the business. Now, I would value it very much if you think so far I've shared some ideas with you that are good and you'd like to like this video. It will only help others that are doing searches on YouTube for the same content to then like and subscribe so YouTube knows about it. So hit the like button. And if you want to be able to pay attention to some of my future videos, make sure you hit the subscribe button. All right. So now when you value a business and it's a $1 million business with EBITDA of $100,000, it's about 2 times the value. If you have $300,000 in EBITDA, you might be able to get 3 times the value. So if you have $300,000 in EBITDA, instead of 2 times of $600,000, you might get 3 times of $900,000 as a selling price. Or if you have $500,000 in EBITDA, you might be able to get 4 times the value of your business. So increasing your EBITDA or your net profit increases what the multiplier could be and increases what your selling price can be. When deciding to sell your business, it's emotional. You've had this business for a long time, and you're going to have to let go. And the new owner is not you. They're not going to make the decisions the way that you do. You have to decide how long you want to be involved. Do you want to be involved for 30 days or 60 days just to kind of help make the transition from the customers and the employees and the suppliers to the new owner? Do you want to try to be around longer? It is not uncommon for an owner to want to stay longer, but then the new owner has to decide if that's what they want. And if the old owner stays on, they might be able to earn extra money or increase the selling price based upon future revenue. So if you sell the business with $100,000 of EBITDA, and let's say that in 2 years, if you could get the EBITDA to $120,000, then you come to an agreement with the new purchaser to pay a larger price. That's a win-win for everybody. When we talk about processes and systems, and they need to be written down, the reason is that it will happen when you are not there. If they're not written down and you're the only one that remembers them, then they're not going to be able to be repeated because it's in your head, it's not in theirs. Write it down. And if you're not sure how to do that or how to go about doing it, ask somebody in your office or in the shop or in the field to write it down for you, or record it on an audio recorder on your cell phone. At least it's recorded, and then figure out how to get it written down. But the value of your business is increased if everything is written down. I attended a educational session from Arch over at Closet CRM, and one of the things that Arch said that really struck me was that if you find out from an owner that's selling a business that they hardly ever go on vacation or they're hardly ever off of work, that to him, that's a warning flag. That's not a good thing. Because if the owner has to be there all of the time, then the company can't stand on its own without that owner. So slowly, if you're going to decide to sell your business, then you're going to want to figure out how you can not be there every day, but the business still runs without you. Selling a business is not like selling a home, and it's not like selling an automobile. If you think about it, when you want to buy an automobile, you decide from all of the manufacturers maybe which one you want to buy. Or you say, I'm going to buy an SUV. Let's look at all of the SUVs. Or I want to look at all of the four-door sedans. And you don't care about the manufacturer. But you have many choices and you start to narrow them down. Well, buyers of businesses do the same thing. They may not be interested in a certain industry. We're in the closet and storage industry. And so, but somebody could come along and buy a business that's in the closet and storage industry that has no experience at all. But what they saw was they saw the EBITDA. It was the right amount of money, or it was the right size, or the seller was the right seller, or it was in the right geographic location. When you're selling your business, you're competing with every other business that's for sale in your area. And that could be from a pizza joint to a fast food establishment, to a painting company, to HVAC, to a fast print service. It could be any type of business yours is in competition with. And so you want to make sure that your business looks good compared to all of the others. Why should somebody buy your business if they're going to spend money, $200,000, $400,000? If they're going to spend money, why should they buy your business over somebody else's? And the real answer is that it's a good investment. The reason they're going to spend their money is they want to get a return on their investment. One more thing I want to mention are payment terms. So when it comes to payment terms, how you get paid is important. So when you buy a house or a car, it's whatever the purchase price was, the buyer gives the money to the seller, and the deal is done. In purchasing a business, it's not always like that. It's usually some money at the closing, some money sometime later, and a final payment sometime after that. And part of the reason for that is there's uncertainty. We're not sure what we're buying. We think, okay, well, we buy this business and it might have a shop, or it might have a lease, or it might have trucks, or it might have equipment. But that's not the reason a buyer buys a business. The reason the buyer buys a business is the customers, or the processes, or any special ingredient that makes that business special. And so they want to make sure that what they bought is what they're getting. What the what the seller said is what actually happens. And so when it comes to value and increasing or decreasing value, some of the things are EBITDA, customer data, meaning your CRM, your accounting data and your chart of accounts, your processes, your systems, assets, employees, jobs under construction, or any repeating business. Then we've got the process itself. It starts with what's called an NDA, a non-disclosure agreement. The seller signs a non-disclosure agreement that they won't share that data with anybody else, because once that NDA is signed, the seller then provides to the buyer all of the pertinent information, financial statements, whatever the buyer thinks is important to consider the value of the business. Customer lists, vendor lists, selling prices, processes, systems, you name it. Because at that point, the buyer is trying to determine if they want to pay what the seller is asking, right? So you've got the NDA. After the NDA is signed, then you've got the sharing of information. After the sharing of information, an LOI, or letter of intent, is written and agreed to and signed. Letter of intent says, all right, you've given me the information. I'm going to pay the $200,000 for your business with these payment terms. On this date will close. Your status will stay for 60 days, etc. So there's the letter of intent. And that establishes pretty much everything. After the letter of intent is what's called due diligence. And that's where the real work comes in. At that point, the buyer does its due diligence. Will ask for your bank records, might look at every single expense that has been paid out of the company for the last year. Was it a correct and accurate expense? They're going to check this against your bank records or against your tax statements, because they want to make sure that what you've said is actually what occurred. Once due diligence is done, it goes to contract. That's the full contract of everything that's going on. After the contract is the closing date. So that's the process. Now, if you've enjoyed this video and you think you've learned something, thank you. But if you want my checklist of things to be aware of for when you want to sell your business, please feel free, put a note in the comments below, your email address, or send me an email asking for it. I'd be happy to send you my list of the checklist of what to do when you want to sell your business. And then next up will be how to prepare your business for sale. And yes, you want to start preparing your business for sale 3 to 5 years from now. All right, well, thanks a lot. And again, my name is Tim Coleman with Coleman Collaborations Consulting Group.